You've heard it 1,000 times. The S&P 500 is up today. Or, the S&P 500 just hit a record high. But what exactly is the S&P 500? Why does it matter so much? And why do investors around the world watch it so closely? Today, we're breaking it all down, from its origins to how it shapes markets, economies, and even your retirement account. The S&P 500 stands for the Standard & Poor's 500 Index. It's a list of 500 of the largest publicly traded companies in the United States. This list represents about 80% of the total value of the U.S. stock market. That's why it's considered the most important benchmark for American stocks. But here's something most people don't realize. The S&P 500 isn't a complete list of every big company. It's a carefully selected sample that aims to reflect the overall health of the U.S. economy. Companies like Apple, Microsoft, Amazon, Coca-Cola, and Johnson & Johnson are part of this index. The list is maintained by S&P Dow Jones Indices, and it's not static. Companies can be added or removed based on factors like market size, profitability, and how often their stocks trade. The story of the S&P 500 begins nearly a century ago. In 1923, a company called Standard Statistics began tracking a handful of stocks. Later, it merged with Poor's Publishing to become Standard & Poor's. The full S&P 500 index as we know it today was launched in 1957. It was one of the first to track hundreds of companies, rather than just a few. Since then, it has survived booms, busts, and everything in between. The dot-com bubble, the financial crisis of 2008, the pandemic rally of 2020. Through all of it, the S&P 500 has served as a real-time story of the American economy. So, how does a company get into the S&P 500? First, it must be based in the United States. It needs a market value of at least $18 billion. It must be profitable, and its stock must be traded often and easily. There's also a committee that meets regularly to decide which companies belong and which do not. Another key thing to understand is this. The S&P 500 is market cap weighted. That means companies with a higher market value carry more influence on the index. If Apple's stock moves up or down, the whole index feels it. The top 10 companies often make up over 30% of the S&P's total weight. So even though there are 500 companies in the index, a small number of giants can move it the most. The S&P 500 is not just a number on a chart. It's the benchmark used by investors, institutions, and analysts around the world. Trillions of dollars are tied to it through index funds, retirement plans, and exchange-traded funds like SPY, VOO, and IVV. When people say they want to buy the market, they're usually talking about investing in the S&P 500. It's also a signal. When the S&P 500 rises, it shows investor optimism. When it falls, it can reflect fear or economic stress. Many long-term investors use it to track their own portfolios. Some even treat it as a shortcut to owning a piece of corporate America. Of course, no index is perfect, and the S&P 500 has its critics. Because it's weighted by market cap, it can become overly concentrated in a few sectors, especially technology. It also doesn't include small-cap stocks, or many fast-growing startups. That means it may miss parts of the economy that are innovative but still emerging. And even though it's used as a barometer for the U.S. economy, many of its companies do business globally, so global trends can affect it just as much as domestic ones. Understanding these limitations helps investors make better, more balanced decisions. If you're wondering how to invest in the S&P 500, the answer is surprisingly simple. Most people use index funds, or ETFs, that track the S&P's performance. Popular options include SPY, VOO, and IVV. These funds are designed to mirror the index. They include all 500 companies and follow the same weightings. That means you get broad diversification with just one purchase. It's low cost, it's passive, and over time, it has delivered around 10% average annual returns. Of course, markets go up and down, but for long-term investors, history shows that the S&P 500 has been a powerful engine of growth. The S&P 500 is more than an index. It's a reflection of business, innovation, and investor confidence. It moves with headlines. It reacts to earnings reports, interest rates, and global events. but across decades, it has shown resilience and long-term growth. If you want to understand how markets work, how economies evolve, or how your retirement savings are growing, it starts here. This is the S&P 500. Follow Trading Key as we unlock the markets, one lesson at a time.